Let me ask you this. What did you do differently with your money after COVID-19 hit? If you were like most other people, you might have started looking into the stock market closely. I mean, you're not alone. Since then, the mutual fund investments have skyrocketed 2.5 times. And it's not just a wild guess. AMFI's data clearly show that the investments in July 2019 were 25 lakh crores, which has catapulted to 65 lakh crores in 2024. That's nearly 2.5 times more money in just a span of 5 years. But here's what concerns me the most. People still are unaware of what mutual funds are. And even worse, those who are investing, at least 50% of them are making way less money that they potentially can make. Hi, I'm Aditya, a finance professional. I'd like you to stick around with me till the end of this video and you'll precisely know what mutual funds are so that you don't have to go through all the troubles. Even if you are an absolute beginner, you don't have to worry about anything. After all, we're all here to make money. So first, let's take what are mutual funds. The term itself, mutual fund, loosely translates to mutual, meaning collectively done with the same intent. And funds, well, funds means money. So mutual funds are financial instruments just like FDs or bonds, but a little bit different. In mutual funds, money is collected from the investor with the sole intention of generating better returns so that the people who have invested in those funds can make more money passively. The money here is invested in different securities like stocks or bonds, which otherwise is a little bit complicated for an individual to follow. Now, all this might sound a little rich folk talks and maybe a little complicated, but here's the best part. It is actually accessible for all, and it is one of the simplest way to make money passively. You just have to be aware of what mutual funds are and how do they function. Now, for better understanding of how do they actually work, let's take an example. Let's imagine there are 4 kids who want to play cricket with a season kit. Now, here's the problem. They don't know which kit will suit their needs. So what they do is they turn to a neighborhood adult who have had a lot of experience in playing cricket. He gave them a simple solution. He asked all the kids to chip in a little bit of money. He then collected the pool of money, and on behalf of those kids, he bought the season kit which might just fit the needs of those kids. With his experience, he now knows that this kit would be safer for them to play with. Now this way, all of them have a cricket kit to play with. And second, they didn't have to research themselves as in which ball or bat or other equipments will fit their needs. Because here they trusted that adult's decision in making the right choice. Now think of mutual funds in the similar way. Like those kids who wanted to play cricket with a season kit but had no idea of which equipments would be better for them. You might also want to invest in certain stocks or other securities but might not have the time or knowledge to spare as in which stock is going to be the best fit for you. This is precisely where the mutual funds comes into play. Here, mutual fund can be considered as that neighborhood adult. Now consider mutual fund as that experienced adult. Just like with his experience, he bought the perfect cricket kit for those kids. A professional fund manager with decades of experience will collect money from you. He will then invest that collected money into the stocks or bonds or other securities which might suit your needs. Now with his experience, he will be able to pick just the right stocks. Now these stocks and other securities over time will generate better returns for you. So in a manner, that fund manager is actually making money on your behalf. So just like those kids did not have to worry about which equipments they should buy, you don't have to worry about which stocks you should prefer. Just like those kids had the safety net of the choice that the experienced adult made, you will also have the safety net of the investment manager that will choose the stocks for you. Just like those kids don't have to worry about making the wrong decisions, you don't have to worry about making the wrong decisions about your investments. The fund manager will help you build your wealth for your needs, and the fund manager doesn't stop there. They will not only pick the right stocks for you, but they'll keep analyzing your portfolio. They will keep adding the securities which might perform even better or rebalance your portfolio if any stock or bond, any security is not performing to the optimum. Also, they continuously monitor 24/7 each day of the month. So one, they can make money for you, and two, they will keep your money away from all the risks because it is way important to save the money from the risks involved in the stock market than actually making even more money. So their sole aim is going to be finding better opportunities so that they can make better decisions on your behalf and you can make money over time. So this way your money is in capable hands and you don't have to worry about navigating in the complexities of the stock market on your own. Now, when you invest in a mutual fund, you don't actually own those stocks. Rather, you own the units of that mutual fund. This is a little bit technical stuff. If you don't want to get into all this, you can skip directly to this timestamp and you'll still be good to go. And if you still want to know the technical jargons, I suggest to stick around. Let's make it even more simpler. Let's imagine you, along with your 3 friends, want to eat a pizza. So you all contributed equally and bought a 4-slice pizza. So now each one of you have your own slice. That slice represents your share of pizza. Now, since you contributed equally, you get equal amounts of slices. That means each slice for every one of you. Now, that one slice represents your share of pizza. Similarly, in the mutual funds, instead of slices, you own units. Just like one slice is your share, one particular unit of mutual fund is your unit that you invest in. So in the mutual fund industry, instead of pizza slices, you call them units. And the price per unit is called NAV or net asset value. Just like a company that is listed in the stock market, the price that you see is represented as a unit. For example, if the stock of Reliance Limited is 3,000 rupees, so what you see is per unit price of that company. And the shares that you will buy of Reliance will cost you according to that per unit. Similarly, when you invest in a mutual fund, what you do is you purchase that mutual fund on the basis of that per unit cost, which is called NAV. So if the total investment in a fund is 100 rupees and there are 10 units, each unit will cost 10 rupees. Just like share prices change daily, the fund's NAV might also change daily according to the performance of the stocks inside of that fund. So when you invest in a mutual fund, you're buying the units of those mutual funds at their current NAV. Now let's summarize everything that we have learned till now into a scenario. Let's imagine that a fund manager collects 100 rupees. Now that 100 rupees is the worth of that fund. This 100 rupees is also going to be called as asset under management or AUM. Now let's say that the fund manager has invested these 100 rupees in 10 stocks. And for easier calculations, let's say that 10% has been invested equally. So now 10 rupees is invested in 10 stocks. So now we know that 10 rupees is invested equally in those 10 stocks. Each stock's weightage in the portfolio of that fund is 10%. So now if you will invest in that fund, 10% of your money is going to be invested in each of these 10 stocks. Let's say now you invest 10 rupees in that fund. So 10% or 1 rupee is going to be invested in each of these stocks. Now, as these stocks will grow, your 1 rupee or your investment is also going to grow. Now, why these fund managers invest in a portfolio of stocks and not just 1 or 2 stocks is another day's story. I'll make another video for that as well, so make sure you subscribe. Now, this is the best part that I like about mutual funds. We now know that these fund managers do all sorts of complex things like picking the right stocks, keep monitoring it, finding the momentum or another opportunities in the market. Basically, on your behalf, they make money for you. And even after doing all this 24/7, each day of the week, every month, what they charge you to do all this is a fee as low as 0.52%. This is really amazing. Because when you think of this in terms of number, for example, if you have invested 1,000 rupees and they charge you 1%, you'll just have to pay 10 rupees for all this complex job that they are doing for you. Now, this is just the base of what mutual funds are. And don't get me wrong, there is still a lot to learn and to know about this miraculous investment instrument. Make sure you subscribe because there's definitely way more coming your way. Also, let me know in the comment section, what do you want to know next? Till then, I'm Aditya. See you in the next episode.